Okay, it's 2 minutes past the top of the hour. As we usually do, we will go ahead and get started now that we've given sufficient time for everybody to join. I do want to say this has been a very popular topic for the CEFLI membership. I know that fraud is often a topic that individuals are seeking information on, and we are very pleased to have Maynard, Cooper, and Gale join us as an affiliate member and partner with us on this great webinar that we have planned. So with that, we will go ahead and get started with our usual introductory content before turning things over to our featured speakers. For starters, I want to pause a moment and thank our premier partners. CEFLI has a number of premier partners, and the list continues to grow. We appreciate their additional support to CEFLI. It helps us continue to provide a variety of programming for our members. Their logos appear on your screen. And we would also like to extend a sincere thank you to our affiliate members. Their logos are on your screen as well. As you'll recognize, we often partner, as we are today, with our affiliate members who are experts in their field. So we appreciate their support of CEFLI. We like to cover a brief agenda of content with our meetings before we go ahead and get started. The first thing that I want to reference is CEFLI's antitrust policy. Got a little ahead there. And that is that CEFLI is committed to adhering strictly to the letter and spirit of the antitrust laws. And we are conducting meetings under auspices designed solely to provide a forum for the expression of various points of view on topics described in the programs and agendas for the meetings. Under no circumstances shall these meetings be used for any competing companies or firms to reach an understanding, whether that's expressed or implied, that could impair the ability of members to use independent judgment. So we will monitor, make sure we don't have any discussion that would venture into antitrust areas, and if so, we'll make an objection, or we encourage you to make an objection, typically with an educational webinar that's not going to be of concern. Shortly, we will begin our presentation, but before we do that, I just want to let everybody know that if you do have questions while we're covering content here today, know that you are welcome to ask those questions. Please use the Q&A feature of the platform. You should have a little button you can click on that will bring up a Q&A panel. So if you have a question, they are welcome throughout the presentation. We'll also try to allow some time at the end for questions, but typically it can be more timely to handle those questions as we go along. And then the final administrative comment that I want to mention here too is that if you can stick around to the very end, I do have a couple of administrative slides that will provide some additional guidance. For example, how to obtain a certificate of attendance form for those who attended the live version of this webinar, and then some insights regarding some upcoming CEFLI activities. So with that, I am going to move us forward here. I'd like to extend a warm welcome to our presenters here today. First, I'd like to introduce Alexander Feinberg. Alex is a shareholder in Maynard, Cooper, and Gale's litigation section in the insurance practice group. He has represented insurance companies in numerous cases across the country in both state and federal courts, as well as before various arbitration tribunals and regulatory agencies. Alex's practice primarily focuses on life, disability, and long-term care insurance litigation matters, including cases involving insurance bad faith, insurance fraud, and complex coverage disputes. Welcome, Alex. Next, I'd like to introduce Mary Carolyn Wynn. And Mary Caroline is an associate in Maynard & Cooper's litigation section and is a member of the firm's Insurance and Financial Services Litigation Practice Group. She focuses her practice on defending insurance companies and other financial institutions in a variety of complex litigation matters. And she routinely represents life insurance companies in claims, interpleader sales practice, rescission, and bad faith matters. Welcome, Mary Caroline. With that, I will turn things over to the both of you to get us started through today's presentation. Thank you.
Yeah, thanks, Carla, for that introduction. And I want to thank CEFLI for allowing us to present today on fraud, which is the other F word, as we like to call it around here at Maynard Cooper. Just before we get started with the presentation, a little additional background on us. Mary Caroline and I are located in Birmingham, Alabama. but our firm, Maynard Cooper, has offices across the country. Our practice group, the insurance practice group, has approximately 40 attorneys who represent insurance carriers and various financial institutions across the country in litigation and regulatory matters, most of which implicate fraud in some form or fashion. As Carla said, we encourage everyone to ask questions today, softball questions only, I hope, but we'll try to answer as many as we can as we go along. Carla, if you'll go to the first slide for me, please. So insurance fraud. I know everybody's sitting on the edge of their seat waiting for us to define insurance fraud for them. In general, insurance fraud occurs when an individual or an entity commits some form of deception in order to obtain an unlawful gain under an insurance policy. As we all know, not only can insurance fraud be the subject of civil liability, but insurance fraud is also a crime, which means that it can be prosecuted criminally and result in fines and even jail time in certain instances. In fact, many states have adopted insurance fraud prevention acts, which set forth specific criminal penalties for individuals engaging in fraud. And as we know, insurance fraud can occur at different points in a transaction. It can occur at the point of sale of an insurance policy, during the underwriting process, during the administration of a policy, and frequently in the claim submission process. There truly is no one-size-fits-all definition or example of insurance fraud. Some classic examples of insurance fraud include misrepresenting facts in an application for insurance, which we're going to cover more in depth in a bit, and forging beneficiary changes under an insurance policy, which we see quite often. In preparing for this presentation today, I saw a statistic that the insurance industry as a whole collects over $1 trillion annually in premiums. When you think about that, the massive scale of the industry, it provides significant opportunity and incentive for individuals to commit fraudulent activity. And given the limited resources that insurance companies typically have, there's no way that every instance of insurance fraud can be detected. And in fact, most insurance fraud goes undetected every year. And there are people out there that try to capitalize on that and bank on the fact that their insurance fraud will go undetected as well. Before we move on, two other things I want to mention, just the difficulty in detecting insurance fraud. The first is insurance fraud is always evolving. There are individuals that are always coming up with new ways to game or scheme the system, and fraudulent activity that was prevalent 12 years ago when I started practicing law is not as prevalent anymore. And there are new areas, emerging areas, especially with the COVID-19 pandemic, that are on the forefront these days of fraudulent activity in the insurance context. Another obstacle that we see with insurance fraud is the public's perception of insurance fraud. Studies suggest that consumers are generally disinterested in reporting insurance fraud or devoting any sort of significant resources to combating insurance fraud. And that's mainly because they view it as a quote unquote victimless crime. They rationalize that insurance companies have lots of money and no one really gets hurt when an insurance company has to pay out on certain claims every once in a while. Next slide, please. Now, insurance fraud costs a significant sum annually, which is estimated to be in the billions, although it's difficult to place an exact figure or value on that amount since, as I just mentioned, most insurance fraud goes undetected. And as you can see from the second bulleted point there, the FBI estimates that a total cost of around $40 billion a year is attributable to insurance fraud, and that's insurance fraud as a whole, not only life policies, but P&C policies, and all other forms of insurance. I've seen higher estimates, I've seen lower estimates, but suffice it to say, it's a significant amount of money, and approximately 15 billion of that is attributable to life insurance fraud. And it's important to keep in mind too that these costs are incurred despite the fact that insurance companies use various anti-fraud measures and technologies. We all know insurance fraud can be harmful to insurers for obvious reasons, but as we discuss fraud today, I think it's also important to be mindful of the trickle-down effect that insurance can have on the everyday consumer. I had a law school professor that said there's no such thing as a free lunch, and I think that's especially true with insurance fraud. The costs are going to get passed down, and they're going to get passed down to the consumer in the form of increased insurance premiums. And you see there a statistic, the FBI estimates that that results in an average increase of $400 to $700 per year per family in premiums. So when you look at this, when you look at it from this perspective, I think insurance fraud is not really the victimless crime that everybody thinks it is. It only affects insurance carriers. Next slide.
All right. Well, before I get started on this slide, I just wanted to say it's a pleasure to be here. And if you see me making any weird faces or have a weird pause or anything like that, I'm 8 months pregnant, so I'm probably getting kicked in the ribs. Think I've got a future soccer star in here, but hopefully she'll be pretty calm during this presentation. So there are different types of insurance fraud, and it can generally be classified into two forms of fraud: hard fraud and soft fraud. Hard fraud consists of claims that are 100% false in nature. It is the intentional creation of a false scenario in order to collect an insurance settlement. Foreign deaths that are fraudulent fall within this category. In the automobile insurance context, and intentionally slamming on your brakes to cause a collision, that's an example of a hard fraud. And then there's soft fraud, which is also referred to as opportunistic fraud. And that consists of policyholders misrepresenting previous or existing conditions to get a lower premium on their insurance policy. Outside of the life insurance context, soft fraud consists of exaggeration of legitimate claims of loss or injury. In a property loss, exaggerating that that you have fine art that is very expensive when in fact you have just a print or something to that effect. That's a soft fraud. And obviously soft fraud is a lot more prevalent than hard fraud, and it's much more difficult to detect. So we can go to the next slide. And so there are different forms of fraud, internal and external fraud as well. Internal fraud is fraud by an agent or an insurer, and there are different forms of fraud internally. So first is false policy fraud, where an agent issues a false policy certificate or insurance identification to improve their writing record. Scammers can also pose as insurance agents and may attempt to sell false policies. There's premium fraud, where an agent may collect a premium and then issue a false policy or no policy at all, which leaves the insured with no coverage. There is fictitious payee fraud, where an agent or employee changes the beneficiary of record to a fictitious or non-living person, and then upon the death of the insured, submits a claim for the policy proceeds and pockets those proceeds. There's what's referred to as sliding, which is where an agent includes additional coverages in the insurance policy without the knowledge of the insured. The extra charges are hidden in the total premium, and since the insured is unaware of the coverage, few claims are filed. And then there's twisting and churning, where an agent encourages the replacement of an existing policy for a new policy with no benefit to the insured, often through high-pressure sales techniques. And there are state regulations that forbid sliding and twisting and turning in most states. Next slide, please. So these are a couple of examples of internal fraud. These are kind of extreme examples. Most often there are smaller scale frauds that occur, but these are pretty extreme examples of those. So the first occurred in Los Angeles, California. Former life insurance agents were busted for a $1.9 million scam between 2013 and 2017. Two life insurance agents submitted more than 600 fraudulent life insurance applications to multiple insurance companies, and they collected $1.9 million in advance commissions. In order to obtain personal identifying information for these applications, the agents set up a referral program and paid agents between $25 to $50 for referring family members or friends to life insurance companies. Some of the applicants were told that they were applying for life insurance policies, and the agents would contact them with premium information. And other applicants never received follow-up phone calls and were unaware that the policies they applied for were ever issued or enforced. In some cases, multiple applications were submitted with forged signatures without the consumer's knowledge. The applications that were submitted to the insurance carriers also contained misrepresentations and fabricated information regarding occupation, income, net worth, and beneficiary information. Obviously, this fraud was uncovered and these individuals were prosecuted. Similar example occurred in Utah 2 years ago in 2020. An insurance agent admitted to collecting commissions for more than 24 fraudulent insurance applications and was sentenced on 11 felony charges. The agent admitted to writing over 25 applications for various companies. They used personal information of multiple people to apply for these policies. And obviously, in this example as well, the fraud was uncovered and there were severe consequences that occurred. We can go to the next slide. So then there's external fraud, which is fraud by an insured or beneficiary. Application fraud, also known as material misrepresentation, is where an insured knowingly provides false information or fails to provide relevant information to the insurer during the application process in order to obtain lower premiums or coverage that the insured would otherwise not qualify for. And this is by far the most common form of life insurance fraud, and we will discuss material misrepresentations at length in this presentation. Then there's death fraud. This is another extreme example of a hard fraud, but this is where an insured attempts to fake their own death, or a beneficiary attempts to fake the death of the insured in order to collect the policy proceeds. Then there's beneficiary fraud, where a beneficiary kills the insured in an effort to recover policy proceeds. There are state laws that prevent beneficiaries from recovering proceeds in these instances. These are often referred to as slayer statutes, and that the proceeds are paid to the contingent beneficiary or the insured's estate, where it can be proven that the beneficiary did in fact kill the insured. Then there's beneficiary forgery, where an individual forges a beneficiary change on the insured's policy, making himself a beneficiary or increasing his share of the proceeds. And both these forms of beneficiary fraud, Alex and I see relatively commonly, particularly in the interpleader context, where an insurer can bring a lawsuit where there are competing claims to a policy and a beneficiary. There are competing claimants to the policy, and the insurer files the lawsuit to have a court determine the proper beneficiary to the funds. Next. So this is an example of a death fraud. Obviously, as we discussed, this is a really extreme example. It's not very common. But in this particular example, which occurred in Minnesota, an individual faked his death in order to have his ex-wife collect a $2 million insurance policy. He was arrested in the Republic of Moldova and extradited to the US when it was uncovered that he was not in fact dead. In 2011, a dead body was found in Moldova, and the dead body included a passport with this individual's information. His ex-wife traveled all the way to Moldova, identified him as her husband, and then received a death certificate, submitted the claim for $2 million, and a funeral was held. But then the couple's son was stopped by Border Patrol in Michigan after agents received digital photos of him very much alive. So this fraud was uncovered, and restitution, the recipients of the funds were required to make restitution. Next.
All right, so this is more death fraud, and this case is near and dear to my heart. It's the case of Aubrey Lee Price, which is one of my favorite cases that I've been involved with as an attorney at Maynard Cooper. Not because there was any sort of unique novel legal theory that we were dealing with in the case, but the facts of this case, just like the one Mary Caroline just mentioned, seem straight out of Hollywood. They like you're watching Dateline on Saturday night. I mean, it's facts are hard to believe, but Mr. Price was an investment fund manager, a bank director, and a Baptist preacher in Georgia who embezzled millions of dollars from his clients, I think $40 million to be exact, through a Ponzi scheme. As with any good Ponzi scheme, ultimately the law, in this case the FBI, caught up with Mr. Price. Knowing the FBI was closing in, Mr. Price wrote letters to his family and friends, giving the impression that he was going to commit suicide. He boarded a plane to the Florida Keys, got in a dive boat, and was not seen again. Presuming he was dead, a receiver was appointed to help distribute Mr. Price's assets to his defrauded investors. And a Florida court issued a presumptive death certificate for Mr. Price. And as many of you may have guessed, Mr. Price had several life insurance policies, which the receiver sought to collect on and was successful in getting those death benefits to distribute to the defrauded investors. Fast forward a year later, during a routine traffic stop in Glenn County, Georgia, which is just outside of Brunswick, Georgia, Mr. Price was discovered alive and was promptly arrested. If you go to the next slide, please. So we represented two insurance carriers in that matter who filed suit to get their money back, as life insurance policies are, by their very terms, only payable when somebody's dead. The receiver didn't want to give us the money back, wanted to retain the funds, and she argued that she wasn't required to give back the funds under the voluntary payment doctrine, which essentially is the theory that the insurers paid knowing that Mr. Price may not be alive, knowing there were suspicious circumstances surrounding his death, and now the insurance companies can't complain that he's shown up alive. Well, ultimately, Judge Batten in the Northern District of Georgia agreed with us. We prevailed on summary judgment and were able to recover the insurance proceeds for our client insurance companies. For those of you wondering out there, I think Mr. Price now is 5 years into a 30-year jail sentence for his embezzlement scheme. Next slide, please. All right, I want to spend, as Mary Caroline said, a few minutes talking about material misrepresentations. which again is probably the most prevalent form of insurance fraud that we see on the life insurance litigation side. You see there, according to an LA Times analysis, which seems like a reputable source, material misrepresentations account for the majority of contested life insurance claims out there. Again, just thinking about the costs, material misrepresentations can be costly to both insurance companies and the insureds. Obviously, from an insurance company's perspective, you can pay on a policy that was procured through fraud. And you can also have to devote significant resources on the claim side to investigating these contestable claims when they come in. From the insurance perspective, I think the biggest thing is it can cause your loved ones not to receive the death benefit after you're gone. It can also be reported to the Medical Information Bureau. You could receive a hit if you try to apply for additional insurance in the future, that you could be declined because of that. And it also could result in criminal fines and penalties. Next slide, please. So here are the four main types of misrepresentations that we typically see in life insurance applications. We've taken questions from applications that we've had cases relating to recently. The first is relates to medical misrepresentations. This is by far the most common misrepresentation that we see in insurance applications. It's likely due to the fact that applications contain detailed and numerous questions about an individual's health history. The second most prevalent misrepresentation we see is related to tobacco history. And I just want to note there, with the failure to disclose tobacco, in many cases, it's not so much intentional fraud as it is an unintentional lack of disclosure. Obviously, people convey information through their own set of filters. And if someone who may occasionally smoke but is intending to quit in the near future is asked, "Hey, are you a smoker?" that person may truthfully to them say, "No, you know what, I'm not a smoker." But nevertheless, it's still a misrepresentation that's technically legal fraud that allows for rescission of a policy in most jurisdictions. The third type of material misrepresentation that you see there on the screen involves risky activities such as skydiving, extreme sports, rock climbing, free diving. We had a case several years ago where the insured failed to disclose in his application that he moonlighted as a skydiving instructor on the weekends. Well, as you may have guessed, the insured passed away within the 2-year contestable period as a result of a skydiving accident. And unfortunately, his misrepresentation precluded his family members from recovering on the policy. The last one there relates to income, net worth, and other life insurance. This is important because an insurer doesn't want their insured to be overinsured, doesn't want them to be worth more dead than they are alive. In my experience, misrepresentations are the most common on life insurance policies with lower face amounts. That's because the underwriting in these policies aren't as comprehensive, they're not as robust, and most insurers, in fact, have simple or quick issue processes for policies where policies with face amounts under a certain threshold don't go through any underwriting at all, provided that no medical history is given in the application process. Most people know this, for sure. Agents know this out there, and they attempt to capitalize on by obtaining these policies where no medical information is required, and they just play the odds that either the insurance company won't learn about the alleged misrepresentation or the insured will outlive the 2-year contestable period. Next slide.
Alex, I'm going to jump in here real quick, if I may. We did get a question that came in, and it pertains to one of the previous slides, perhaps the one just right before this, a slide or two. And the question is, in reviewing these confirmed fraud cases, were there indicators in the appointment process or other process that insurance carriers could have picked up on sooner? So kind of any warning signs that as an insurance company you should kind of watch for to pick up on this type of activity.
Yeah, and is that in relation to foreign deaths? The fake death claims or the cases that we've seen?
I'm not sure which case that this
Well,
one would have pertained.
I know we're going to talk about red flags later on in the presentation, but on if the question related to the fake death claims that we saw, I mean, obviously the red flags, foreign deaths are the number one red flag I think that you see just because other countries don't keep records like the United States does. And the majority of fake death claims out there originate or the scheme occurs in another country, and individuals try to use foreign death certificates that can often be purchased or manipulated, forged, and submit those to insurance companies to try to gain insurance benefits.
Very good. Thank you. And thanks for referencing the red flag that we're going to cover in a little bit. Appreciate that.
We've got you covered. All right, so how do insurance companies fight material misrepresentations? Well, as the screen says, insurer's best tool in fighting material misrepresentations is rescission. Rescission has its roots in the English common law over 1,000 years ago and is historically based upon a claim that a party was fraudulently induced to enter into a contract. Rescission is an equitable remedy because the primary goal there is not monetary relief, but to put the parties back to their respective positions as if the contract never existed. It's basically an unwinding of the transaction, under which insurers have to refund all premiums that were received in connection with the policy. And I want to mention one other thing here while we're on the slide. Rescission generally has to be based upon questions and information that was solicited through the application process. It's within the four corners of the contract. If, let's say, for example, an underwriter interviews an insurer or a potential insured through the application process, and the insured may represent something related to their history there that may not be true. Usually in most circumstances, because that's outside the contract and the application, it can't be used as a basis for rescission. Next slide, please. All right, so rescission can be based upon specific statutory requirements, and in most states it is, or it can also be based on the common law. Grounds for rescission we found are most frequently, but not always, discovered post-claim after there's been a death. However, insurance carriers can become aware of grounds for rescission, obviously, even without filing a claim through audits, for example. Think about this question. When grounds for an insurance or a rescission first become known while the insured is still alive, is it incumbent upon an insurance company to investigate further and take further action at that time to rescind the policy? Everybody should be shaking their head yes out there because the answer is yes. Obviously, you don't want to risk a waiver or ratification type argument. Waiver meaning that you knew about it earlier, but you didn't do anything at the time, and therefore you've waived the right to rescind at a later date. Ratification means you knew about the potential misrepresentation, yet you continued to accept premiums and acted inconsistently with the right of rescission. And the other big thing out there is that you risk that the insured will live past the 2-year contestable period, and then you won't be able to do anything about the misrepresentation. You'll be stuck with the contract. Below are the common elements of a rescission claim for misrepresentation or omission. And the first one being that the misrepresentation of a present fact that is material to the decision to underwrite the risk, reliance by the insurer on the misrepresentation, and then damages proximately caused by the misrepresentation. That said, this basic criteria varies among different jurisdictions, so it's important that you look at the specific state-specific jurisdiction when considering whether or not to rescind. Next slide. Regarding the materiality aspect, most states engage in a but-for analysis. But for the misrepresentation, would the insurer have issued a policy with a different rating? But for the misrepresentation, would the insurer have issued the policy with a different face amount? But for the misrepresentation, would the insurer have charged a higher premium? We've included one of the examples of statute from New York that defines materiality. There are other states like Colorado, for instance, that do not define by statute materiality, and it's defined by the common law. Another thing that I want to point out too here is that materiality issues can arise where there's a change in health after an application is submitted to the carrier, but before the policy is placed in force. And to that end, most insurance companies require applicants to execute a statement of good health prior to placing a policy in force, basically attesting that there's been no change of health since they completed the application. But in signing that, they can be the basis for a material misrep claim too. In fact, we had a case previously involving a $10 million Keyman insurance policy where the insured, after submitted his application, but before the policy was placed in force, went to his physician, had a stress test on the treadmill, immediately went to atrial fibrillation, and his personal physician drove him to the emergency room, which is about 1.5 miles away. Couple days later, insured submits a good health statement to the insurance company saying, hey, I'm in the same health that I was when I previously submitted my application for the coverage. As you might have guessed it, this turned into a lawsuit. The beneficiary contended as part of the lawsuit that the insured didn't understand that his change of health was material or significant, needed to be reported because at the ER, he was given aspirin and sent home and told to monitor it. Of course, we pointed out that it was crazy that he didn't understand the significance. His personal physician drove him to the emergency room. I would guess that most people on this call have not had their personal physician drive them anywhere. It's pretty unheard of. Next slide. All right, so one of the critical questions you need to ask when determining whether to rescind a policy is whether the particular jurisdiction requires intent to deceive, whether that's an element of the claim. Now, the vast majority of jurisdictions out there recognize rescission can be based upon an innocent or negligent misrepresentation. There's no intent required. But there are a minority of jurisdictions where there are intent-based element of a material misrep fraud claim. This obviously complicates rescission efforts. It's hard to get in the mind of an applicant or insured and prove what they were thinking at the time. This is especially true when the situation arises where there's been a death and the insured's not there. You can't go ask him what he was thinking at the time. But it doesn't mean it can't be done. You can't rescind in these circumstances. It's just more difficult. Another consideration that you want to look at here too and be mindful of is whether your application alters the applicable standard. For instance, does the application state that the responses were given to the best of the insured's knowledge, information, and belief? In some jurisdictions like California, Florida, I think Illinois, to name a few, this can alter the innocent misrep standard and transform it to more of an intent-based standard. Next slide, please.
And Alex, I'm going to jump in one more time. I apologize. We did get a question that actually came in through the chat function. I missed that coming in a couple of minutes ago. And the question is, should the premiums be returned to the estate of the insured or to the beneficiaries? I think it's going back to that death case that you recently illustrated.
Yeah, that's a very interesting point, and that comes up more frequently than you might think, and it's jurisdiction dependent. There are some jurisdictions out there that require you to refund the estate. I think the vast majority, which I've seen in practice, the insurance companies refund the beneficiary. And a lot of times it's because there's been no estate opened. It's just more practical to refund it to the beneficiary because if anybody has a claim on a policy, once somebody's dead, it's the beneficiary, and you're more likely to get sued by the beneficiary versus the estate.
Very good. Thank you, Alex.
And I think we may be, yeah, if you'll go one slide ahead, please. Now, this is Alabama's rescission statute. This is a typical one that you'd see in most jurisdictions. We included it obviously because we're located in Alabama, but I wanted to point out two things here. One, notice that it's written in the disjunctive. There's the or there. So you can prove any one of those three elements, and that's sufficient to justify rescission of an insurance policy. So, for instance, under prong number one, on the fraudulent aspect, you can have fraud and it can serve as the basis of rescission, even where the fraudulent misrepresentation may not have been material to the issuance of the policy. There you see in Part B at the bottom of the screen, that's the unwinding of the transaction that we previously talked about, the refunding of the premium, and you have to place it into the registry of the court. Next slide, please. Here's a little more on the materiality standard. And I have the first point there for purposes of noting that the law differs from jurisdiction to jurisdiction on the materiality standard. You know, some jurisdictions you analyze it from an objective standpoint. Other jurisdictions you analyze it from a subjective standpoint. Objective being from the standpoint of a reasonable insurer, and a subjective standpoint being from the standpoint of your own underwriter that signed off on the decision to issue the policy. And that's a good segue to the last point that I have there. But, and especially in jurisdictions where materiality is analyzed from a subjective standpoint, your case often lives or dies by the underwriter. And it's critical to have an underwriter with good credentials that'll stand up well on cross-examination and who does things by the book. Point two there, in your materiality analysis, you not only want to ask if the underwriter would have taken additional measures, you also want to play it a step further and say, okay, well, if we'd have done this, we'd have done these additional measures, what information would that have yielded and how would it have impacted our analysis? And if you still would have issued the same policy at the same rating, same face amount, same premium, then chances are it wasn't material for purposes of a rescission action. On the third point, those are just some best practices before you determine whether you want to rescind on materiality, and we'll go over some more in a minute. But you'll obviously want to look at whether the discretion or the underwriter had discretion. And you also want to look at whether the underwriter had made similar exceptions in the past to issue policies based upon the same health conditions. You know, this happens more frequently than you might expect, usually through a concession that's made to a broker who places lots of business with an insurance carrier. And it's going to come out at a deposition if the case ever gets litigated, and it's best to know it on the front end. Next slide. So here are a few general considerations that you want to look at when determining whether or not to rescind a policy. The first one we've talked about is the applicable law governing the rescission. Obviously, you want to be able to establish these elements if you are going to bring a rescission action. Second, you want to look at the contract. For instance, does the contract contain language that limits or alters the applicable contestable period? Some do. You also want to look at whether the application question at issue is ambiguous and is maybe susceptible to more than one interpretation. You know, most jurisdictions out there construe language in an insurance policy against insurers. And then the other one that I want to mention, and we've covered it, is the language of the application and whether that potentially alters the innocent misrep standard and transforms it into an intent to deceive standard. And then third thing you want to look at is whether there was an agent involved and whether potentially statements made by the agent or statements made to the agent could be attributable to the insurance carrier. You know, I jokingly tell my wife that if I ever die and an insurance company denies your claim, just to tell them that we discussed it with the insurance agent at the point of sale, they gave the sign off, said it was okay, not to worry about it. We see this in insurance fraud cases all the time. It's a common tactic employed by plaintiff's counsel, and it's often difficult to deal with because it turns down to a credibility, he said, she said issue. Just a few other things you want to consider when determining whether or not to rescind a policy. And this first one is in instances where there's been a death. Some states require a causal connection between, I think Arkansas is one of them, between the misrepresentation and the cause of death. You also want to look at the significance of the misrepresentation. You know, for instance, for a tobacco related misrep, are we talking the occasional cigarette, or are we talking, you know, a pack a day for the last 30 years? In our experience, juries are much less likely to grant rescission on an issue that they view as trivial, and they see an insurance company that just wants to get out of paying a death claim. You know, you also want to think about the potential defenses that you see in these misrep cases that get litigated, and the main one being, is there any information in the underwriting file that should have caused the insurance company to investigate further? While insurance companies are not under a general duty to investigate the accuracy of information provided in an insurance application, there is an exception to that rule, and where, and let's say an application or an underwriting file contains certain information, putting an insurer on notice that something may be amiss, they have a general obligation in some states to investigate further. And I'll give you a quick example of that. And I know Carla's coming up with a question. Most insurance companies run a script check on during the application process. Well, what happens when that script check comes back and shows that an individual was prescribed a drug commonly used to treat, let's say, cancer, or tobacco cessation medication, or one used to treat atrial fib? Well, most plaintiffs' counsel are going to argue out there that you were on notice that of the potential issue. You issued the policy in light of that, and now you've waived any right to rescind the policy.
Okay. I do have one question that came in through the chat feature, and I'm just going to read what we have here. It is the jurisdiction case law that of the residence of the applicant or the insurer?
Yeah, it's usually the state in which the policy was issued and delivered. Now, there are obviously exceptions to that. Some states employ a restatement, and it looks at significant contacts, but it's safe to say in the majority of jurisdictions out there, it's the state where the insurance policy was issued and delivered.
Thank you, Alex.
And next slide, please. I'll just briefly touch on this. These are how to rescind an insurance policy. The first tool is a voluntary rescission. This is typically only successful where the insured is still alive and you catch the misrep on the front end or in the contestable period. Most insureds will agree to rescind a policy when they know they've been caught red-handed with their hand in the cookie jar. It's less effective when there's been a death. Most beneficiaries don't have intimate knowledge of the insured's medical history, and they just find it hard to believe that their recently deceased loved one or friend would ever lie to an insurance company. Second bulleted item there is you file a rescission action. This is by far the most common instance, and that's whether you file it offensively or whether you assert it defensively after you've been sued in litigation. One thing I want to mention is there's some jurisdictions out there that require you to assert a counterclaim for rescission, and there are others out there where you can simply just assert it as affirmative defense. The third one I want to mention that's not listed there is unilateral rescission. Some jurisdictions allow for it, and it's simply notifying a policy owner that you're exercising your right to rescind and refunding the premiums. However, note that there are jurisdictions out there that require you to file a DEC action to validate the rescission. Next slide.
Alex, we did have one more question that came in, and that is, have you ever seen a defense verdict in a misrepresentation case based on illegal drug overdose by the insured?
I have not. I've seen those more in the accidental life context, and I'm assuming it's because there was some sort of fraudulent misrep about illegal drug use during the application. I've seen lots of cases where individuals have misrepresented their illegal drug use. You get police records on the back end and find out, they've used whatever substances that are illegal. Uh, I think it certainly helps your case if the death, let's say, for an overdose and the misrep relate to each other, although it's not necessary for a rescission action.
Thank you, Alex.
Okay. I know that we're kind of running up on our time limit here, so I'm going to run through these warning signs of fraud pretty quickly. But there are some warning signs of application fraud to look out for, where information on a life insurance application is vague regarding details of health history, such as dates and location of treatment, names of physicians or hospital, or what the specific diagnoses are. If the applicant fails to sign and date the application, if the applicant's earned income or net worth does not warrant the amount of insurance being applied for, also if the applicant is self-employed and is seeking a high value policy, that can be a bit of a red flag as well. Applications are left unanswered. The applicant's date of birth does not match other insurance applications. We've actually seen that come up recently. Or if the applicant has excess insurance, either disclosed in the application or discovered through underwriting. Next slide, please. These are some warning signs of claim fraud. If a death claim is presented and the insured death occurred outside the country, obviously Alex mentioned that's a huge red flag. If the autopsy discloses a different height or weight or other physical characteristics than what was disclosed on the application, or other medical records don't match. If an attorney immediately becomes involved in the contestable claim or interferes with the investigation, or if a claimant is being very pushy, pushing for the claim to be processed quickly, or if a contestable death claim is reported as an accidental death but could potentially be a suicide. Next slide, please. These are warning signs of agent fraud. If an agent offers insurance premiums at a significantly lower rate than other insurers, over 10 to 15% less than other insurers, is pretty suspect. If the agent uses aggressive sales tactics, pressuring the consumer to act quickly at the risk of increased premiums due to any delay. If the customer receives a bill that is higher than the initial policy projections or illustrations, or if a representative or agent's only business is replacement contracts, that is a warning sign. Next slide, please. So here's a little information. Obviously we are still in the wake of COVID-19 right now. I think in 2020, most of us thought that the pandemic would probably not last this long, or we hoped that it would not last this long, but it is still here with us, and it's led to an increase in fraudulent activity that affects businesses across sectors. The Association of Certified Fraud Examiners recently published a report where 77% of respondents had experienced an increase in fraud levels, and 1/3 said that the fraud increase was significant. And that's true in the insurance industry as well. In that same report, 81% of respondents reported an increase in insurance fraud, with 41% expecting the increase in fraud to be significant. And these Frauds have manifested in a variety of ways, including increased disability and workers' compensation claims, increased fraudulent medical billing schemes, and increased fraudulent life insurance claims. Next slide, please. So there are increased incentives with COVID-19. Many people are facing unemployment, other financial strain, economic uncertainty, and mortality concerns with the virus. So there's increased demand for the financial certainty that life insurance provides. But these same factors also create incentives for applicants to deceive insurers in the application process. And there's also increased opportunity because COVID-19 has disrupted many standard business practices. Many people are operating their workforces remotely. And, I think what we thought might be remote work for an initial period has now become an extended period and maybe semi-permanent. So safeguards that were used may no longer be available, such as advisor meetings or paramedical exams, and insurers may feel increased pressure to accommodate customers by implementing express claims processing. Next slide, please.
So unfortunately, despite everyone's best efforts, cases sometimes just get litigated. And when this occurs, it's important to take early affirmative steps to put the company in the best position to win the case down the road. This starts before the response is ever filed. Nick Saban, who is Alabama's famous football coach, attributes a lot of his success in collegiate athletics to what he calls the process. And that's a consistent dedication to doing the small things right. And that's the kind of mindset you have to employ when dealing with fraud cases. A few steps that you can take early on from an insurance company perspective. Number one, get it to your outside counsel early so you can come up with a game plan for attacking the complaint. Make sure your litigation holds go out to the right folks, and then gather documents and information and recorded calls that may slip through the cracks, may roll off the system because of a document retention policy that may not be caught up with a litigation hold. In fraud cases, we like to adopt an early aggressive strategy typically, which usually involves filing a motion to dismiss. We've listed here a few of the common arguments and theories that we set forth in a motion to dismiss. The first is not being able to satisfy the heightened pleading requirement for fraud. Plaintiffs must plead the who, what, when, where, why, and how of a fraud, but often don't. The second is the economic loss doctrine. This is where a plaintiff attempts to tortify. I don't know if that's a word, maybe I just made it up, but an ordinary breach of contract claim in order to trump up their damages. Then you have the merger clause defense, under which you can't use parole evidence to vary the terms of a contract. This typically arises when a plaintiff's counsel tries to use an agent statement made to an insurer to vary the terms of a contract. Then the last is the statute of limitations defense. Actions have to be brought in a certain amount of time or they're untimely. And statute of limitations for fraud claims is relatively short. And for life insurance fraud claims, typically 2 years. Carla, we've got several more slides, but I know we're abutting against the 1 o'clock time limit.
Yes. So I think maybe what we will do, I see we have a couple of slides. Maybe we can just try to cover them briefly. I hate to cut short the content because you have some really great content here. And just for everybody else's benefit too. If you do need to step away and jump on to another meeting, no problem. Totally understand. We are recording the session, so we will make that available. And I will send all of you an email message within the next couple of days that has both the slides and a link to the recorded presentation. So if you miss any of the tail end of this particular webinar, you'll have an opportunity to catch up with that. So Alex, I'll turn things back over to you. Thank you.
All right, we can go to the next slide. These are some slides about how to combat fraud. As you know, insurers must strike a delicate balance. The business of insurance is absolutely a balancing act. Insurance is highly regulated and competitive, and companies must deal with insureds fairly and communicate with customers clearly. At base, it's a customer-focused industry, and underwriting and claims handling have a significant impact on a company's image and reputation, but there is some element of adversity between the company and the consumer. So it's a challenge to strike the right balance, and carriers are continually faced with pressure to become more efficient and cut operational costs while also keeping in mind that preventing fraud is fundamental to the bottom line. So next slide, please. There are 4 fundamental steps for insurers in combating fraud. First is to implement a foundational framework. Second is to understand and prioritize the relative levels of fraud. Third, you can apply data analytics. And fourth, continually reviewing processes. Next slide, please. So really the most important thing that can be done is establishing a framework for addressing fraud. It's critical to implement clear procedures for underwriting and processing death claims. Employees should have an understanding of what the company's procedures are and why those procedures are in place. The foundational framework should reflect a strategy that addresses questions like how can we check all claims for fraud, but also ensure fast claim processing? How can we improve fraud investigation efficiency? How can we keep track of changing fraud behaviors? And how can we reduce false positive signals? And then once the framework is established, it should be clearly communicated throughout the organization. It's critical that those involved in fraud detection stay up to date on red flags. And to the degree possible, an insurance company should create checks and balances and have multiple employees review applications and claims, particularly those that are high value or otherwise atypical. And communication and collaboration throughout the organization is really critical. Next slide. It's also important to build a strong special investigations unit. A special investigations unit is a division within a company, or it can be an outsourced company that focuses on detecting, investigating, and reporting insurance fraud. Since the late 80s, most insurance carriers have been mandated by statute to form and maintain an in-house special investigations unit or contract those services out, and that mandate is still in effect today. So it's all about a function of efficiency and effectiveness. If a claim presents one or more red flags for fraud, it may be referred to the Special Investigations Unit. The SIU can train claims adjusters on spotting hidden red flags that might indicate fraud is being committed. They cooperate and work closely with law enforcement. And because they do work with law enforcement, there should be clear guidelines for the SIU of what's expected of them in conducting their investigations. Members often have investigative experience and are frequently former law enforcement officers or private investigators. It's important to identify individuals and build a team of people in the SIU that are ethical, persistent, that they know the law and are competent to stand up under scrutiny. Because like underwriters, members of the SIU can, become critical in litigation. And from a litigation perspective, it's essential to have thorough investigative unit that can gather evidence to support the denial of a claim. Clear, convincing evidence that can be used at summary judgment often saves the company time and litigation costs down the line. Next slide, please. So prioritizing claims is also critical. Knowing the relative level of fraud for every type of claim allows for the best action to be taken to maximize efficiency and savings. Since life insurers are often limited to 2 years in rescinding policies, time is really of the essence in identifying fraud. So prioritizing certain claims is necessary often. Certain applications, in particular, those for high value policies, should be prioritized, and medical and financial records should be reviewed with scrutiny. And setting a baseline for the value of applications that will be reviewed during the contestable period may be a strong practice if all claims cannot be reviewed. For instance, investigating medical and financial records for all applications for policies exceeding $500,000 may be a good policy to implement. Next. Then utilizing analytics to combat fraud. Insurers now have a lot of technology available to them, and they should leverage the technology to refine fraud detection and prevention. This can be done by taking available historical data and converting it to actionable intelligence. So past claim denial records should be recorded in an electronic database so that new claims can be analyzed against this historic data, and fraud can be detected through pattern recognition. Past referrals to special investigative units should also be recorded. So obviously record keeping is key here and maintaining that in a database. And I know we previously mentioned the Medical Information Bureau, but that's an external database that is critical to use in detecting fraud. The Medical Information Bureau can alert an insurer to an applicant's previous applications for insurance that were denied. Next. And then just keeping a systematic review of processes. There should be annual fraud review meetings with relevant personnel that are involved in fraud detection, including underwriters, claims analysts, and the special investigative unit personnel. And during this review, it's critical to analyze the success of the fraud prevention strategies that were applied throughout the year, looking at what was most successful and whether there were any processes that may have been ineffective that can be changed moving forward. And then it's also critical to look at any novel fraud schemes or red flags that emerged since the previous annual review, and encourage relevant fraud personnel to look out for those moving forward. Next slide, please. And then there are certain prevention measures that can be taken, in particular with respect to fraud in the post-COVID-19 world. These include avoid relaxing safeguards used in the claims review process, validating the death certificate. Obviously, this is critical outside COVID-19, but especially within COVID-19, and investigating all contestable claims thoroughly. An example of why this is relevant is, people whose deaths are attributed to COVID-19, the medical examiner may not include a pre-existing condition as a cause of death, but medical records identified in a contestable claim investigation would reflect the existence of a pre-existing condition. So it's just important to continue that thoroughness, particularly in light of the pandemic. Next slide, please.
All right, we've made it to the end. So thank you everyone for bearing with us while we went over time. But just to summarize, continue to monitor emerging trends, collaborate with your peers in the industry, speak with your outside counsel about trends that they're seeing. Don't get complacent. I think above all else, you have to have a realistic outlook. Fraud's always going to be there. You're not going to be able to eradicate fraud completely, but the goal is to implement certain procedures to best help the company mitigate against the effects of fraud.
Very good. Since we're running a little bit long, I think we will pass through the question slide and we'll move on to some of our very quick administrative comment. But before we do that, I do want to pause and express a sincere thank you to Mary Caroline and to Alex for joining us today. Excellent information. I love the information that you shared regarding actual cases that you've worked through, as well as the ways that you can be proactive in trying to mitigate insurance fraud and prevent it and manage it. Well done, both of you. Thank you. And with that, just a couple of reminders before we conclude our webinar here today. First, we always get this question, so I want to make sure it gets covered a couple of times, and that is we will make the slide deck available as well as a link to the recording of this particular webinar on cefli.org. I will put that out there probably within the next day or two, so if you did want to have access to those slides, or if you had, for some of them, individuals who had to jump to another meeting, they'll be able to catch the back portion of this webinar via that link. Second, we usually get a lot of questions regarding our certificate of attendance. And while CEFLI does not file its materials with any state bar associations or with continuing ed groups on the compliance or ethics side, we do make a certificate of attendance form available to individuals who may want to self-submit for CLE in the states that allow that, or for CE with organizations that you may belong to. And if you would like to receive a copy of that template form, you may reach out to Nancy Perez at cefli.org. Her email address is on the screen here today. I also want to mention our post-event survey. When you close out of this webinar, you will be prompted to complete our post-event survey. We do value your feedback. It's extremely helpful to us as we think about the content that we plan to cover for the remainder of the year, our approach to presenting information during our webinar events. We encourage you to complete that form. And then finally, just want to mention upcoming events. On February 9, we will have our next webinar, and we will actually feature the results of CEFLI's recent AML benchmarking survey. Some of you may be aware that we conducted a survey at the end of last year. We've analyzed those results, and we look forward to presenting the learnings from that survey during the webinar in February. We will plan to send out communications regarding that webinar and open up registration for that on cefli.org tomorrow. So with that, I will close out our webinar here today. Thank you all for joining us and sticking with us. It's been great content, and thanks again, Mary Caroline and Alex. We've enjoyed conducting this webinar with you today. Thank you. Thank you all.